Welcome to this end of financial year update. I'm Julia Lee, an equity strategist with Bell Direct. And in the financial year to date, we've seen the Australian market rising by 9%. If you include dividends, that rises to 13.5%. But really, the year has been a tale of two halves, where towards the end of 2016, we saw the market rising towards November as well as December. But in 2017, we've really seen a sideways movement. We have seen the small caps underperforming this time round with a rise of only 2%, but mid caps up by 14%. So really, in terms of the market, it has been the banks that have done the heavy lifting in this financial year. Just comparing the Australian share market with our international peers, and unfortunately the Australian market has underperformed. Just having a look at the US stock market, and in the same amount of time we've seen the S&P 500 gaining 15%, the Nasdaq has gained a massive 28%, and even the boring Dow Jones Industrial Average has managed a gain of 19%. Looking around the region and comparing to our peers, and Japan's managed a gain of 28%, the Korean Kospi is up by 20%, but the Chinese Shanghai Composite only up by 8.5%. So the Australian performance more in line with China than some of our faster growing regional peers. Having a look at sectors, and it's been healthcare that's been the standout area with a rise of 15%. Unfortunately, telecom has been the worst with a massive fall of 25%. Looking at best and worst performers on the ASX 200, the top three this year: Whitehaven Coal up by 150%, A2 Milk up by 120%, and Qantas up by 100%. On the flip side though, the worst performing, Vocus down by 60%, Sierra down by 50%, and Aconex down by 50%. So I guess looking at the financial year ahead, well, what do we see? Rising US rates will continue to be a feature, although we are seeing some subdued data coming out of the US. And of course, the risk is that we might not see as aggressive a time frame for rising interest rates as the market is expecting. All in all, there are some risks towards US growth, especially some of those Trump policies and whether they can deliver. And this is why we prefer Europe to the US at the moment. In terms of Australia, with the market trying to pinpoint the peak for the housing market as well as infrastructure, it is a little bit more difficult. At the moment, we are trading in a sideways movement. So around the 5,600 point level represents a good buying opportunity, but the market does tend to sell growth towards that 6,000 point mark. But for investors, it is time to think about positioning for the August reporting season. And I would take care with some of those stocks that appear to be in a downgrade cycle. And these are stocks like Telstra, Ardent Leisure, Adairs, in the retail space, RCG, as well as in the construction space, Watpac. On the flip side though, some of those growth stocks continue to do well, and they're stocks like AGL Energy, Aristocrat Leisure, CSL, Cochlear, as well as ResMed. So expecting to see stocks like this continue to outperform, and preferring to be positioned for those stocks that appear to be in an upgrade cycle rather than those in a downgrade cycle. So that's it from me. I wish you all the best in the new financial year. I'm Julia Lee from Bell Direct.